I have Samiran Chakraborty, the chief economist at Citibank India, joining me. And let me toss the first question. Sonia has already asked that, and I think that will be top of the mind recall. How bad does it get for the rupee at all, and therefore, how good for the economy?
Rupee has to be always seen in a relative context. So what is happening is today, because the dollar is getting very stronger, against dollar, rupee is weakening, but against a basket of currencies, if you look at the 36-country RER, rupee is still significantly overvalued. In fact, I would say it's more overvalued than what it used to be, because in the last 1.5 months, rupee has actually been one of the outperformers in the EM space. But the fact of life also is that there is a rotation of funds going on, which means that from Indian markets, about $3 billion have gone out in the last few days, both from debt and equity combined. And that's putting pressure on rupee. We don't think that the broad strategy of RBI in managing rupee within a band with a gradual drift towards depreciation, that broad policy has changed much. But the range can shift significantly if dollar gets stronger on the back of better US data, or once President-elect Trump draws his main broad policy conclusions.
So for December 31st or for March 31, broadly, what is the level you're looking at?
So we're still looking at broadly a 66, 68 kind of a range to be
so
held.
Not 69, not on your cards?
Not as yet. We want to see this dollar strength to really continue for a while, that this is not just a knee-jerk reaction to new information that has come to the market, but it's a more stable 100 plus on DXY. If that's the case, then we will probably be shifting the range upwards.
Okay. Well, clearly yesterday that gave the rupee coming towards the 68.50 mark did rattle some foreign investors who are perhaps working on very thin margins. But Samiran, the more important point is, what have you done with your growth forecasts? There is at one end Ambit, which had an attention-grabbing contraction of the economy in the current year, but most other economists have restricted themselves to probably a 1 percentage point cut or less. Yours is?
We are working with this year about a 0.5% cut in the GDP forecast, and for next about a 0.4%. But that 0.4% is not just because of demonetization. In any way, we were probably thinking that the first year of GST implementation could have a bit of a growth headwind. It's just a combination of both. Maybe that's why this next year's number is looking a bit higher than what the demonetization effect should just be. In our mind, it's probably a bit early to judge the full impact of demonetization. Our base case is that it's a very sharp fall followed by a quick pickup. Not really a very prolonged disruption of the economic activities in the economy, and that's why working with a somewhat lower number.
No, you may well be right. I mean, what if of that 14.5, 15 trillion, 12, 13 trillion came back, then obviously the dislocation is much lower than we thought. I mean, we're all really groping here. But Samiran, I think the more important call is on inflation and interest rates. Yields have fallen to 6.2 on the 10-year. From where was it? 7.5 in April. What's your sense in terms of what RBI will do now? What will it do next year? How many rate cuts do you pencil in? 6 quarter now? Where is the repo 6 months down the line, 12 months down the line?
We have a 25 to 50 basis point rate cut call, but I must add that call was even before demonetization. And to us, it's not really a question of whether it's 25 to 50. It's more a question of timing, where we have more uncertainty, because the yields have fallen so much, interest rates, deposit rates, lending rates, everything has fallen. Would RBI actually keep the powder dry on December and wait to cut sometime later? That's the bigger question in our mind than the rate cut per se. Because as our base view seems to be that the growth slowdown is sharp but not permanent, I cannot really go ahead and call for a significantly larger amount of rate cuts. That will be inconsistent. So if some point of time, if I'm proven wrong and the growth slowdown starts to be more permanent, then yes, there is scope for revision to that view as well. But as of now,
is it dovetailed to growth at all? I was under the impression that, let us assume 3 lakh crore, 4 lakh crore, 5 lakh crore doesn't come back. You're taking out aggregate demand. So should not next year's inflation be very benign? Inflation should give you scope for more rate cuts, no?
Well, in theory, the money that is not going to come back, and loosely we call it black money, the marginal propensity to consume out of that black money anyway is very low. So the only effect you are going to get is the wealth effect on consumption, which is not as large as the income effect from consumption. So that's why we are not estimating a very large impact on consumption out of this decline in black money.
Okay, so what are you looking at in terms of 10-year yields? This 6.2, is it? I mean, it's already discounted the rate cuts. What is the 10-year in March? What is the 10-year 1 year from now?
I think we have to be careful here that when we say 6.2, how much it is discounting. In normal circumstances, you can make that calculation, but these are abnormal circumstances where exceptionally higher demand compared to supply is driving yields, not really so much rate cut expectations. So inferring rate cut expectations from the yields is pretty tricky at this moment. My sense is that once things stabilize, we will probably realize that with 25-50 basis points where we are today seems to be a good level. But in the interim, if deposit growth remains to be much stronger, we could see more upside to this rally as well. And the final point would be that once the new equilibrium stabilizes, how much additional deposits do we get in that equilibrium? How much of the economy actually becomes cashless? That's where we will get a better view of where things stand. And let's not forget that the fiscal is definitely going to look better both this year as well as next year. That should also help yields to some extent. I
would have asked you the fiscal question, but I think we have to wait for December 31st and get an idea of how much money is not returned. So we'll leave that question to a later day. Samiran Chakraborty, thank you very much for